Robschild, thanks for tuning in. No investment advice. Welcome to the show where we view financial markets through crystal ball gazing. J.P. Morgan once said, "Millionaires don't need astrologers, but billionaires do," and so we begin. Today is Friday, August 23rd, 2024. Today's episode, Powell spaketh. And the market heard, "You guys want some candy?" Large cap answered, "Only some candy." Risk assets answered, "Whoopee." Daily reminders, 2-year, 10-year yield curve inversion is past its second birthday, meaning we are very, very, very likely headed straight into a pretty bad recession or depression. 2 years of an inverted yield curve is highly unusual and I believe has not happened since before the Great Depression. The SOM rule has also been triggered. Unemployment is going up really fast, even though it's still low. The numbers are rising at a rate that triggers a rule that has been correct about marking the beginning of a recession every time that this has happened. And here we are today. Let's go to the charts. Overall, not a huge reaction to today's speech, as some people may have been expecting. We went back to yesterday. We had in the Fed funds futures a predicted one rate cut of 25 basis points for the September meeting and one for November and then two for December. And instead we moved it up a month again. So we're back to one cut for September, two cuts for November, and then one cut for December, and every meeting after another cut until June of 2025. Again, this has been just flipping back and forth all over the place. It's pretty much 100% certain that we are getting a 25 basis point cut at the very least in the September meeting. If more data comes out before the next meeting that shows even more weakness, especially in labor markets and CPI, if inflation gauges are showing, things are cooling off even faster, then yeah, we could get two cuts. And someone was talking about recently, I think it was priced in yesterday, that there are some players betting on three cuts now, or they were yesterday at least, but I don't see that in this chart here. Looking at the market, starting with the S&P 500 large cap index is what I considered the S&P 500, and they said only some candy. We did not crack above. We didn't even get above yesterday's high. We opened below yesterday's close, and we opened and closed below and above yesterday's open and close. So this is an inside day. This is typically this doesn't take out the bearishness of this red candle. It's still more likely that just for a chart pattern for this to go lower here, following the line that I drew, that I am still expecting at this point to play out. Remember, this news is now done. Jackson Hole, the speech, it's over. Now we're waiting for the next piece of data and how that's going to make things happen, or the next news event. So head and shoulders here. Watch out for that, folks. In the triple Qs, the NASDAQ looking even more bearish. Same head and shoulders pattern here. Large engulfing candle of 3 trading days. Very bearish looking. This looks like it's very clearly wants to continue down from here. We had a very tiny little inside day of this large red candle showing the strength of the bears here, really, more than anything. The NASDAQ also saying, only a little bit of candy? We're only going to get a little bit of candy. SMH, semiconductors, same pattern, same thing. Inside day, going down. But risk assets, my oh my. All they could think about was the candy that they were going to get. Whoopee, says the risk assets, and off to the races we went. The Russell popped up over 3% today. Very, very large move to the upside. I have again, remember, this news is out, it's done. I think this is a sugar high, and I don't think it will last. At least that's what I see in my crystal ball. HYG, junk bonds, high yield corporate bonds, also took this news as risk on. Credit spreads are getting very tight here. TLT did go up today, so that does give room for HYG to also go up, but this much, it's like acting like it's on a sugar high, and the sugar high is just never going to go away. And we all know that it does eventually. Credit spreads don't stay unbelievably tight forever. So I have puts on HYG, I have puts on SPY right now. I have calls on TMF, TLT. I'm positioned to take advantage of going the other way here. But again, on the whole, for the day, risk assets said, game on. All right, can't wait for that sugar. ARK-K going up 4.5% today, large move. Bitcoin popping up 5.5% today on all of this news. Loving that the idea of that sugar coming. This is something called you can look up CryptoCap Total 2. This is my understanding, at least when I looked it up, I'm pretty sure this is what it is. Sometimes my charts get messed up. I'm 99% sure that this is the chart that shows all of the other cryptocurrencies minus Bitcoin. And so I do like to take a look at this to see what, really high risk assets are doing. I consider this to be very, very dumb money here. So we popped up 3.8% as well. Apparently sounding dovish. The dollar dropped today, and so silver and gold were allowed to rise a little bit as well. Along with oil, we had a bit of I think we might call this a relief rally. Again, this is not like gold like shooting to the moon from here. This is still well within its trend going down. It's kind of just, had a little bit of relief to the upside today is the way I would describe it. New home sales data also came out at 10 a.m. today. Might have been under the radar for some people because of the Powell speech also at 10 a.m. But we had a large move to the upside in home builders coming near all. Is this a closing? It is a closing all-time high right now. So that market certainly got excited, largely I think because of the new home sales news being a lot stronger than expected. And then I think wood is one of my favorite leading indicators. It had a very bullish day today, up 2.92% today. Obviously, this relates to the home building index. If people expect people to build more houses, the cost of wood's going to go up. So at least on today, again, how long will this sugar high last? Is this a trend change here because of the Fed funds futures, pushing getting one cut now a month earlier than it was yesterday? It's like certainly nothing groundbreaking going on. The VIX futures curve is still anticipating a lot more volatility in October coming up, as I have options contracts that will help hedge everything and take advantage of what I think is going to play out here. Again, it's elevated. Let's see the price here. So it's above the November and December still, and it's below the January. But yeah, again, this is highly elevated. The market is anticipating some crazy things happening in October still. Makes sense. The first cut coming in September. Once we start cutting, it's like people are sort of forced into chasing yield, and then the yield goes down, and it usually plays out the same way every time. Remember, market money market funds, people that have money that's in cash, has been making 5% return with the Fed funds cutting their target rate on the front end of the curve. All of those funds are now making less money, and so people that want more money, or to lock in rates, are going to be reaching out on the curve, trying to hold on to that yield so they can guarantee themselves money coming in. That's how the inversion works. And then once we're cutting, and while it's inverted, the expectation of the amount of cutting is already priced in. And so but what typically happens here is you have your cuts, and then the whole curve kind of goes down as people are chasing yield, essentially guaranteed yields. Lastly, taking a look at the actual VIX, I noted since the Japanese yen carry trade that brought us all the way up to historic level 66, hasn't been seen since the great financial crisis and COVID crash. It was amazing, a historic day. I'm surprised this wasn't a bigger news event, honestly, but I had been talking about this sloping down so nicely, and then it looked like it started sloping up nicely, and we finally broke lower. So we're finally having a little bit of normal movement in the VIX. It's supposed to be up and down and up and down. It's never supposed to be smooth like this. So it actually gives me a little comfort here to see it digesting here. But at the same time, it's pretty obvious to me that there's some trouble ahead. When the Fed comes out and states explicitly that they're trying to save the labor market by doing cuts, that's kind of what's driving them right now. This is not a time to be chasing lower grade bonds, lower grade credit. This is not a good time for tight credit spreads. It's the time for the opposite. It's time for wide credit spreads. It's time to, get away from high yield corporate. I wouldn't touch high yield corporate with a 40-foot pole so much that I bought puts on the other side. I expect this to be collapsing in the very near future, and I can see it happening in October. Hope you enjoyed. Thank you for watching. That's all from me and my crystal ball. See you next time. Robschild.